Welcome to the Deep Dive. Today we're diving into, well, a bit of market chaos, really.
Definitely feels that way sometimes.
Yeah, inflation, tariffs, global stuff. It's a lot. We wanted to figure out how major banks, specifically JPMorgan and Morgan Stanley, are handling it all. Are they just weathering the storm or maybe even profiting?
That's the core question, isn't it? We've got their latest earnings reports to pick through.
And here's the kicker right away. It seems like this very volatility, this uncertainty, has actually pushed trading revenues to record levels for some of them.
It's a strange dynamic. You know, the instability that causes problems elsewhere can actually boost trading activity.
How does that work exactly? More price swings mean more trades.
Basically, yeah. Investors and funds try to navigate or, frankly, capitalize on those big price movements so the bank's trading desks get much busier.
Okay, let's look at JPMorgan first. Their stock trading revenue. A record $3.8 billion. That's up 40%. Just way beyond expectations.
Huge numbers on the trading side, but that wasn't the whole story in their report.
Right. What else stood out?
Well, while trading was booming, they also dramatically increased the money they set aside for potential bad loans. They reserve $973 million.
Wow, okay. And they were only expected to put aside about $290 million.
Exactly. That's a big jump. These loan loss reserves are, a bank safety net for defaults.
So putting so much more aside suggests they're bracing for something, like an economic downturn.
It certainly signals caution. They seem to be anticipating that some borrowers might have trouble repaying loans down the road.
And didn't Jamie Dimon, their CEO, mention something about potential turbulence?
He did use those exact words, yes, adding to that cautious tone.
And it's worth remembering, these earnings figures don't even capture the most recent market swings, the really intense period we just saw.
Good point. So the next report could be even more dramatic on the trading side, potentially.
Yet, despite these record trading numbers, their stock didn't exactly soar, did it?
No, it was more muted. Which really highlights that broader investor uncertainty we mentioned. People see the high trading profits, but they also see the big loan loss provisions and wonder, what does the future really hold?
Okay, so that's JP Morgan. What about Morgan Stanley? They also hit a record in trading revenue, right? $4.13 billion.
They did. Another strong trading performance. But the market reaction felt, a bit calmer compared to JP Morgan.
Anything specific in their numbers that caught your eye?
For me, it was the rise in their non-interest expenses. They hit $12.1 billion.
That sounds like a lot. What goes into that?
General operating costs, salaries, technology. But significantly, it included $144 million just in severance costs.
Related to those layoffs they announced back in March. About 2,000 people.
Precisely. And this really brings the focus onto cost control. When multiple banks are benefiting from these same market conditions, managing expenses effectively could be, a key differentiator for success moving forward.
Interesting. So similar top-line boosts from trading, but different stories maybe underneath with costs and provisions.
Kind of shows different strategies or perhaps different pressure points.
Okay, so let's try to tie this all together.
Mm-hmm.
We have big banks making record money from trading driven by market volatility.
Right, capitalizing on the swings.
But at the same time, they're taking clear precautionary steps, like JP Morgan boosting reserves for bad loans.
Signaling they're wary about what's coming.
It paints a really uncertain picture. And it suggests that cost control, like we saw highlighted with Morgan Stanley's expenses, is probably going to be crucial for these banks to maintain performance, especially if the economy does slow down.
Definitely. Strong revenues are great, but managing the bottom line in potentially tougher times ahead will be vital.
So it leaves us with a pretty big question to think about, doesn't it? If banks are profiting from this current instability, but are also clearly bracing for potential economic trouble, fueled by things like inflation and these trade issues, what are the potential long-term impacts? Not just for the banks, but for the whole economy.
And perhaps what should people be watching? Beyond just the headline earnings numbers each quarter, what other indicators might give us clues about where things are really headed in the coming months? Something to really mull over.